Shut up and sit down.
Alright everybody, welcome back. Today's date is April 24th, 2018, and welcome back to Rebel Trading Group Podcast. This is episode 12. My name is Nathan Oliphant, and with me as always is the gluten-free Jason Bessing.
The gluten-free Jason Bessing. What is up, people?
How are we doing?
I'm doing all right, Nathan. I just recovered. I'm coming back from vacation, so I got that, it was nice. I've got that, post-vacation, you know how you just feel like shit after your vacation?
Of course.
So that's what I'm dealing with right now.
Yeah, everybody always says you need, an extra day of vacation or some shit.
I know. I should have took, an extra day off.
Yeah. You went right back to work?
Yeah, dude. 3 a.m., man.
Damn. All right. Well, let's
recovering from that, but I'm having a coffee. No alcohol on this podcast. This is an alcohol-free episode. This is a Starbucks coffee.
Ooh, SBUX.
It's just Starbucks K cups, but anywho. Oh, now I got to write that one down. Thanks. You're already plugging them out there.
SBUX Starbucks. Look them up.
Anyway, so let's jump into it today.
Yeah.
Markets. We had a little bit of a day. We had some excitement out there. Unfortunately, I didn't get to watch it too much because, as Nathan said, I was at work all day. But the Dow was down 424 points. The S&P down 35 points. Nasdaq closing minus 121 points, and Bitcoin.
Whoop.
Bitcoin is the winner right now. She is up. To $9,460.
What do you think?
I can't do it, but she's up 6% for the past 24 hours. So she's your winner right now. She's outperforming all the markets, the most volatile of them. So if you're a crypto fan, this might be your last call. All aboard. Train is leaving.
Yeah, it's about that time again.
All aboard. This just might be it.
I don't know. Yeah, I don't know. If it's gonna do the same pattern it did before. It hit up to 20,000, then crash again. But
I think some of the shorts now are covering their position because remember, futures are trading on this.
Yes.
That was about 3 months ago it started. So, I think some of the shorts are now having to buy back their positions. People who had to buy it at 13 or sold it at 13, 14 and tried to buy back at 6,000, but it just didn't happen. So
the hodl wall holds.
Yeah, the keep hodling out there. But yeah, just interesting. And some of the alts doing about the same. Well,
whenever Bitcoin, it's kind of like a market kind of herd mentality as well with the cryptocurrencies. Yeah. Whenever Bitcoin really does well, so do the other altcoins do as well. They kind of move together, which is
real quick, good. Sorry, just to go back to the Dow, we while Bitcoin was just ticking up all day, which to me, if you look on a chart, appears to be institutional money coming in. These huge spikes. It doesn't seem like retail investors timing it all together.
With Bitcoin?
Yeah. When you see these huge, if you look at the hourlies.
Yeah. They're what's called whales. They scoop them up all at once.
Yeah. They literally buy several million.
Yeah.
So they take up all the buy orders real quick.
Scoop. No control, man.
In my opinion, that's got to be institutional money. But anyway, while that was going on, the Dow between about 12 noon and 2 p.m. Eastern time, we had about a 400-point drop in about 2 hours. So it went from being up in the morning, we up it was about a nice 75-point pop on the Dow, and then it just sold off throughout the rest of the day. Very interesting. And
3M,
of course, the market followed that.
3M had earnings today. They were down. Here we go. 6.83% today. They're in the Dow Jones.
Wow.
Yeah.
So that was a massive sell-off on the Dow. 3M has that kind of market cap that can kind of persuade the entire. If it's a large enough drop, it can persuade a lot of the market.
Yeah. $2.50 per share earnings. If you're interested.
Verizon, believe it or not, popping up 2% today. General Electric, Pfizer, Verizon, some of the worst performers in the Dow are.
You don't talk shit about Pfizer.
Nike did well, and then everything else just selling off. 3M, yeah, massively. Caterpillar popped, and I just saw that they had earnings today as well, and they did fairly well on their report, but they sold off another 6%.
I was looking at earnings calendar this week, and Amazon does this week.
It's a busy fucking week.
Yeah. It's insane, dude. Earnings season, baby.
Gotta love it. So let's go over to market news with Nate. I'm trying to find a sound for that, and I cannot do it. I might have to get into some paid stuff, but I can't find anything for free out there to get that. So I'm trying, man. I'm trying.
Yeah. Okay.
So what's going on?
So one big thing. Denuclearization of Russia, or not Russia. Whew, man, that would be a huge step. God, bump the brakes. North Korea, I guess was confirmed. I don't know who confirms this.
I mean, I don't really know if it's ever confirmed.
Do you think Kim Jong Un tweets out a response like, "Okay, you win" or something like that?
I think they just came forward with it. I really don't know what to expect, to be honest with you.
Okay, so
I really have no idea because I don't believe it. I'll believe it when I see it.
Okay.
When they send the UN teams to go do through the denuclearization process, when they send in the UN teams to do that, then I'll believe it. But till then, I think it's all fugazi.
Okay, so just before that, we just opened up trade again with China. We kind of eased trade tensions. We had China trade talks.
Mm-hmm.
And then immediately after, a week or after, North Korea says, okay, we will denuclearize. So that opens up trade to the fucking max because the number one exporter or importer to North Korea is China.
That's true. That's very true.
So,
without
is
China,
booming, man. Business is booming.
China and North Korea would not really have much.
Yeah. In other news, Wells Fargo hit with a $1 billion fine.
Woo!
All right.
For what?
Oh, I don't know. I gotta look it up.
Is this part of the scandal where the CEO and the other board members allegedly opened 1 million fake accounts?
You think that's it? It might be related to that.
And then they embezzled money from it.
Anyways, Wells Fargo hits with a $1 billion fine, and then the stock goes up. It was 1% that day. It was unbelievable. I mean, they have on the Robinhood feed. There's a $200 billion financial securities agreement. I don't know. Look it up. There might be some good news. I don't know. But yeah, that's market news.
$1 billion means nothing when you're 230 billion.
Yeah, it's insane. Just fucking write a check. Okay, let's go.
Sorry, we'll pay that off in a month.
Have a mortgage. Start writing mortgages.
That's their coffee bill.
Yeah.
For their offices.
Bring your own coffee. Sorry.
They spend that in coffee.
Yeah.
Anything else going on in the markets? Everything just seems to kind of be pointing to earnings still.
Yeah.
CNBC, we always need a headline. We always need to direct it at whatever's going on. We need to attach whatever's happening to something else. So everything seems to still be pointing towards earnings, and on those headlines, market because of earnings, market because of earnings. So.
Well. 3M, like I said, they had earnings today. They met earnings and down 6%.
Mm-hmm. Now, some of these, that is a thing that happens, and a lot of times you would say why. And number one, it's kind of a shift of the shareholders. there's some shareholders that will use that news to say, okay, I think it's time to get out. And some will use that news. Okay, well, I'll use that opportunity to get in. So there's kind of that battle of the change of shareholders, but also these large mutual funds and institutions and maybe even some large hedge funds. Remember, they can't just buy and sell all their shares at once without massively changing the price. And so they'll sell off in 100 share increments or 1,000 share increments, sometimes maybe even 10,000 share increments.
Dude,
and
could you imagine just dumping 1,000 shares?
Yeah, and you got to do that like 462 times because you have that. Like that's how much is in your portfolio. That's what happens. And these institutions will use. It's literally what it is. These institutions will use good news in order to sell into that, because they say, "Oh, look, they crushed earnings. I'm buying," and then they say, "This is our time to move 100,000 shares."
That's insane.
Yeah, so that's really what it is. Now, one of the only times that you will ever, or that can guarantee that a stock will go up after earnings, is if they beat and raise guidance. 9 times out of 10, that is going to push the stock further, and there will usually be a nice gap up first thing in the morning, or that day if it's pre-market. And if they beat and raise guidance, that means, hey, we're going to make more money than we thought. And those are words Wall Street wants to hear. So,
yeah. One more. I see on Yahoo Finance screaming at me on the front page. Mnuchin going to China to negotiate trade. So,
what was
it? Treasury Secretary Steve Mnuchin will go to China to negotiate over trade.
I like it.
You like
it's
that?
It's time to open up our wallets, babies. So,
dude.
Yeah. What?
That's just so good for the U.S. economy. It is.
Right, so the earnings thing there about everything going on is a very nice segue into today's talking point. Is we're going to finally touch and fondle some fundamentals.
Let's get it. Here we go.
We've been waiting for this. First of all, Nathan, tell me what is fundamentals. Tell me the types of analysis and what fundamental is.
Okay, so there's 2 different types of analysis. There's technical analysis, and that's really basically entering and exiting and trading. And fundamental analysis is really finding the value behind a stock. Like, is it going to grow? Is it sustainable with dividends and stuff? There's certain key measurements that determine the value. Excuse me.
Mm-hmm. And technical uses charts to identify buying patterns and buying trends in order to find entering and exiting points.
They use candles and stuff like that. Definitely charting.
Yeah. And the fundamentals is really going into the nitty-gritty financials of a company and finding the value behind the business itself.
That's correct.
Absolutely. It's a great way to put it. So, Nathan, going back to the earnings thing, kind of open it up. I told you I was going to write down your talking points because this is good segues into it. But with the EPS, when we release these earnings, we have a thing called EPS. Can you kind of explain that concept? Because it's very confusing when you first hear about it.
Okay. So this is how I understand it, and then you can bounce off me. So, I don't know, do you know how they come up with that number? Because it's a pretty complicated way to figure it out. They release it.
Yeah, they release their numbers in earnings per share because they can't just say, well, we made $100 million. Okay, because that means very different things between Rudy's Sub Shop and Disney.
Shout out Disney.
So there's a huge difference if one of those companies makes $100 million. So in order to express how much they actually made, it's put out in earnings per share. So if a company is has 1 million shares and they made $1 million, that means each share generated $1 for that company. So that's how it's expressed. So if it's a $10 stock and it generated $1, it'd be $1 per share. Is how much they made.
Do you look at it as you getting $1 back per that share? Like if it was a $10 share and it was an earnings per share and it said $1 earning per share, would you look forward to getting $11 per share later?
Yeah, because it represents the amount of money that you've put in, quote unquote, is how much it's generating back for you, how much it's working for you, because it represents the health of the company.
Okay.
So companies will often announce we made $2.06 per share, and depending on the share price, that gives a good telltale sign. Is if a $100 stock generated 30 cents a share on earnings, that's not good return on your money, and the stock should not be at $100.
Where does earnings come from? Is that like revenue?
Yeah, it's how much profit was left over at the end of the day.
So is that cash flow from operation?
Yeah, it's from everything that the business does, whether it's a mortgage company or it's a real estate company.
Okay.
If it's an entertainment company. Everything put together. All the bills have been paid. We paid all our employees. This is how much we have left over. And that the company will either pay that out in the form of dividends. They will pay that out in stock buyback programs, or if it's a growth company, like it's technology based or something like that, they will reinvest it in the company, buy more assets, more computers, more employees, more office buildings.
More cars.
And that's another. Exactly. And as they build assets on their spreadsheets, that kind of increases the value of the company as well. So it all depends on the business and how they're using that money.
All right. So let's do an example. You can look it up from it. Okay. Ticker symbol, I'll just tell you, Tesla.
Mm-hmm.
What is their PE ratio? Or what is their, we haven't even gotten into that. PE ratio would be next.
Mm-hmm.
Why don't we just go right into that?
Let's jump into PE ratio.
What is P?
Well, that's the price to earnings ratio.
Right.
It's literally how much money you're getting back for every dollar you put in.
Okay.
And the average for that, the average PE ratio that you want, a good healthy PE, is about 15 to 18%. About 15 to 18, and that means that every $15 you put in, you're getting $1 back. If it's a 17 PE, every $17 that you're putting in, you're generating $1 back. And the way that is let's go back to the company that's a $10 a share and it's got 1 million shares. Well, if they generate $1 per share that quarter, that gives it a PE of 10. Mm-hmm. Because that means that your $10 generated $1. 10 times 1 is 10. Boom. You have a PE ratio of 10. It's a very strong PE. When you're analyzing companies, you want to look for companies that have low PEs. Okay. Low price to earnings ratios, because that means it's cheap in general.
When I look at PE ratios, I look for it relative to its own industry. Mm-hmm. I also look at it relative to the market, which is the average, like you said, is 15, right?
Mm-hmm. You can always pull up the SPY,
the
ETF for the S&P 500, and you can look at that exact PE ratio right there. I don't know it off the top of my head right now, but it's usually around 15%. 15.
I feel like it's a little higher right now.
I think right now it's a little higher. It's around 19. So the market's a little bit overpriced compared to the average. But so that's a good way to kind of price it against the entire index, because if you've got some companies out there that got 700 PEs, but there's just so much hype behind the name, such as Amazon, who has a PE of over like 300. 300. So it's a good way to those two. What are those? Concepts are great ways to instantly look at like what your those two fundamentals. That's right there.
They are.
It's exactly what they are. That's a good way to look at the cheapness of your stock. How much are you expected to return? And remember, those are always looking in the past. Both the EPS and the price to earnings ratio are always looking in the past. They're not looking into the future. So you can't use them as quick, instant guidelines. And that's going to go for kind of everything that we talk about in fundamentals, right? Like, we're going to hit maybe 6 different things right now. Giggity. But remember that you can't look at 1, 2, or even 20 metrics alone and analyze if a stock is good to buy or not. You've got to look at the big, broader picture behind everything. And you got to use each detail as a small piece to the bigger puzzle.
Yeah.
So
you're saying, what you're saying is don't go off PE ratio alone.
Yeah, don't go off a PE ratio, but that is definitely one of the most important ones right off the bat.
That's kind of what I go to first.
Hands down.
When I'm analyzing a stock for fundamentals, I go for the price per earnings ratio. And then I pull it up, whatever Morningstar used to say what the industry average was. Like it would put up.
Yeah, it used to, but ever since they updated, it went to shit.
God, I mean, I can read it.
Bugs me.
The bars are so beautiful, and now they're like small bars.
Bugs me.
Short Morningstar. Just kidding.
They actually do have stock.
Yeah, I think they have earnings this week.
Fuck them.
Short them.
Anyway.
Buy the puts.
So the next one I like to talk about, another great fundamental that I instantly go to, is book value.
Book value. All right. I come in and out of this, and like I'll read it and like, oh yeah, I understand that, and then it kind of leaves my head once in a while.
Mm-hmm. Basically, simply put, and this is a very generic description of it, is if the company decided to close its doors tomorrow, sell off all of its assets, and pay off all the bondholders and all that jazz, it's literally how much money the shareholder would receive. So your goal is, so that basically is the exact value of what that stock is worth. So your goal with that would be to find stocks that are close or below book value. And that's very hard to do. That's very hard to find. So that's honestly the best way to put it. The book value is exactly that. It's the true value of the stock. According to the accounting reports, companies can write things different ways so that there is more or less money in certain areas in order to kind of tweak things. So book value is a great metric to use, great fundamental to use to instantly know the value of the company compared to how much it's selling for. I know an example. Amazon.
Who
has a book value of somewhere around $42 and trades. Where does she close at today, buddy?
Much higher than that.
Pulling it up right now. She closed at 1,460. That's down. That's even down being 4%. So if Amazon, now granted, Amazon will not close its doors tomorrow and have to sell off all of its assets, but God forbid there's some sort of crisis and it does, they have to get broken up or dissolved or something. You're $40 per share. That's what you're getting.
That's not good.
That's not good. Now, granted, you also got to rely on the strength of the company. There's other things like that. The more assets, the more value that the company has, the better the book value. Another one of the best metrics that you can look at is debt.
Fundamentals, baby. Fundamentals.
Tell me how you look at debt for a company, because I know that is another one that you really, really, really look at.
Okay, so it really depends on what kind of sector you're in. So, for example, if I'm going dividend ways and I'm getting REITs, I like a little bit of debt with the real estate company, because debt in that case kind of is considered houses at that point.
Mm-hmm.
But, or with banks, that's how they make money, is they lend out money and they get it back on interest. They have to have debt. When they lend out money, that's part of the process.
Yep.
But other companies like retail shouldn't really have like a lot of debt.
Shouldn't.
They could for like research and development. For example, Blue Apron. They went from 50 mil in debt to like 400 mil in debt from a 1 year stance. That's not good. That's not good. Stock's down 80%. Not good at all. Stock's down 80%.
Not good at all. Because remember, debt is expensive. You have to pay back your debt. It's just like a human being. You have to pay your credit card. You have to pay your mortgage. Well, these companies, they have to pay their bondholders. They have to pay their rent. They have to. And those are the first expenses that come out of their profits is debt, because that's the most expensive. Or that's the most expensive, and that's the biggest part that they have to pay. So you want to find companies that preferably have low debt, because that means they have low costs, or technically lower costs.
How do we measure debt?
The best way to do that is through the debt to equity ratio.
Also known as?
The DE ratio.
Bam.
You might be able to explain that one a little bit better for me.
Yeah, I guess so. I think it's the equity that's on the bottom, on the denominator, and the debt on top. So it's all your liabilities divided by all your equities. And I think they take what is stockholders' equity defined as?
It's the value that they have within their share.
All right, and that's on the bottom. And you put all the liabilities on top, divide it out, and there's a ratio.
How much that company owes. That's the the debt.
Uh-huh.
How much, if you have $20,000 in credit card debt, that's a $20,000 liability.
So if you have a higher debt on top, I guess the best way to describe this is if you have $10 in debt, but your equities are only at $1, it'd be 10 divided by 1, which equals 10. That's really high. So if you had less debt, so let's say you had 0.5 over 1, what is that? 0.5? That's less. That's less debt.
So it's every dollar you have versus every dollar you owe.
Is that what
so
it
it's
is?
Really the debt to equity is every dollar you owe versus every dollar you have. So a 0.3 debt to equity is decent.
Yeah, I like that. That's not bad.
But like you said, there's a lot of companies that thrive off of debt.
Mm-hmm.
Real estate's a big one because they burn through cash because they pay off 90% of their revenue off in the form of a dividend.
Of their profits.
So in order to expand and buy more real estate, they have to take on debt. Banks, they borrow money from other banks and lend it out to you. They have to borrow money to make money. So they require lots of debt. But just exactly like you said, retail should not be having a lot of debt because they don't own their stores. They're always paying rent. And they don't really do much except they act as the middleman, the front man. There's very little reason to have a bunch of debt unless you're kind of just rapidly expanding the company by buying tons of assets, warehouses, I guess, maybe in the beginnings, but these well-established retail companies should not have tons of debt. And for the bigger companies, people will always write them debt. If Coca-Cola wants to borrow $10 billion tomorrow, I'm sure they could get that debt. It might be a little expensive for them, but they can get it. But I use it as a key metric because if
I use it as one of my main metrics.
That's one of my main things, especially if you're looking at a company long term. If they've got tons of debt, eventually that's going to catch up to them. If they can't pay it off. I know Ford has a lot of debt, but that's how car companies operate.
What? Is that just what you're going to end with? That's how car companies operate?
Dude, it is. That is. Look at all the car companies. They all have tons of debt because they needed to build warehouses, new factories. They're constantly building new different types of machines, new research and development. For most companies, it's manageable, but they tend to have lots of debt.
Okay. I can't find debt on Morningstar anymore. That's really
upsetting.
Dude,
it's so bad. It's so heartbreaking, isn't it?
Yeah.
That's a good segue into another one of my favorite ones. It's kind of an it's not an exact metric or anything, but I kind of generalize dividend sustainability. Basically, so if Ford is paying a 5% dividend, I like to look at, well, how much of that can they actually afford? And one of the best ways to kind of, I guess you can kind of target it to one fundamental. One of the best ways to define that is through what's called the payout ratio.
Here we go. Hang on.
Here we go. The payout ratio is how much money. So if you look at the EPS, let's just say that $10 stock generated that $1 per share. How much of that are they paying back in the dividend? If they're paying back 60 cents a share, then that's going to be a payout ratio of 60%. If they're paying back a nickel, they have a payout ratio of 5%. So the lower the payout ratio, the more sustainable the dividend. There's some REITs out there that have 186% payout ratio, which means that they are literally taking on debt to maintain the dividend. And that is not healthy at all.
Let it ride on black.
I like to see payout ratios above 40% because that means that you're getting a good return on your money.
So what is that, 0.4?
Huh? Yeah, so that'd be payout ratio of 40%. It'd be 40.
Oh, okay.
I guess 40%. I think it's usually expressed in percent. But something above like 80 might want you to pump the brakes, because if their sales decline a little bit, that they're paying off a little bit more than they can bite, or they're biting off a little bit more than they can chew. Wow. So you want to kind of find that perfect sweet spot to make sure that dividend is safe, because if that dividend gets cut, it's going to make a lot of shareholders run, and we know what happens when that goes on.
There was a crazy dividend, Bob Evans. Do you remember that?
Yeah, we mentioned that one once in another episode.
God,
BOBE. It was like a $62 stock that paid an $8 dividend.
He cut it straight out, just like a fucking right off the fucking hind, man.
And it paid it back.
I know, dude. It's insane.
You would have got it. You could have someone could have retired off of it. Like, oh yeah, every $62 you're gonna get $8. It was nuts. Okay, so that's the quick, easy way to look at. That's one of my favorite quick little ways to look at dividend sustainability. There's a lot more behind it because it goes into like free cash flow, operating cash flow. It does depend on their debt, because remember, out of that money they're paying off debt. So that's a great way to look into dividend sustainability, because if they don't have to pay off the banks, they can pay off the shareholder. You don't have to pay the bondholders, they can pay the shareholder.
So one of my favorite things I've ever heard is, and one of the things I believe in is, I don't invest in companies that don't make money. Mm-hmm. And one of the key metrics I look for in the fundamentals is cash flow from operations. Do you want to tell us about that?
You are going to have to be the one to talk about that.
Okay. Basically what happens, it's all the money they get after they cut all the bills, they've ran all the engines, they've cut all the toys out, and after everything, this is how much money they have. I know Tesla right now has a super really low cash flow from operations. It's in the negatives. It's like really low.
Yeah, it's they're not making money, and they're burning through it through research and development.
I don't know. No, this is really conspiracy. This is not true. But I think he's burning his cash, taking his investors' money, putting it into freaking SpaceX, and sending his rockets and blowing his freaking rockets up in space. Get your ass to Mars, Elon Musk.
I don't think he can do that, though.
You don't think he is, though?
You think you're saying he's doing it like illegally?
Maybe.
Oh. So it's literally is free cash flow from operate? Is that literally the amount of money that's sitting in their bank account?
What do you mean?
Is that kind of like, so you said at the end of the day, once everything's paid, it's how much cash do they have?
And is that I never really thought about that. Just I figured that's like how much money they're actually making, you know?
Mm-hmm.
I don't know if that's at the end of the day.
Well, the key thing is like when you're going through the fundamentals, you're looking for that to be growing.
Yeah.
So when free cash flow is growing, let's say
that's more money to
if
do
your
shit.
If your allowance when you were a kid was $30 a week, I mean that's a lot. I'm just using a number. I threw it out there.
Damn.
Let's just say it's $10 a week. Well, if when you get older, your mom says, "Okay, I'm gonna give you $12 a week." Well, now you have more free cash flow. You've just that business grew right there, and that's a great way of looking at it. You want to go through the past several quarters, past several years. Are they growing that free cash flow? Is that pushing the company's price upward? Is it increasing more value to the shareholders? Are they decreasing cash flow? Is sales going down? Are they making less money than they were before? That's basically what that instant metric. God, I keep saying instant metric.
Gluten free.
That's a gluten free instant metric. That's what that fundamental is going to tell you.
Yeah. So how far? What's your time period? Okay, so you don't just look at what last year's.
I look over about the past 4 years or so. I look for that. I look for those numbers to be growing. I look for revenue is another good one that I look for.
Hey baby, hey.
And it's kind of it all sounds similar, and it all is. But revenue more so is how much money are they making before they're paying everything.
Before liabilities.
Before you're paying the liabilities. So if they got $770 million in free cash flow, but they've got $1 billion in revenue, well, I mean that's a pretty good little margin there.
And they have more money for like research and development.
Mm-hmm. Being able to put back into stock buybacks, increase dividends,
exactly.
Buying more assets, more employees, stuff like that. And your key is to really kind of find those numbers growing.
Yeah, I was just about to say that. Are you just looking for those key numbers? Are you looking for growth? Do you ever look for growth in PE ratio?
The GPE, I'm not really a huge fan of it. It really depends because it goes on.
Why aren't you a fan of it?
Because it's just a weird number in my opinion. Because I feel like you can and you can't really measure growth. And that's just a weird thing about it. Yeah, you can like see the growth of the stock and the growth of the company, but putting an exact number on like its value of that growth.
What is it called? The PEG or something like that?
The GPE, or sometimes it's the PEG.
Yeah. Oh, careful, coming in hot.
But in my opinion, it's hard to put a number on exact growth.
So where do you put growth on these fundamentals? If you're gonna just name them out, where do you look for growth?
Well, I look at the increasing cash flows.
Yes, I like that as well.
If it's you got to look at the numbers too, like you said. So you going back that 770 mil. Okay, next year if it goes up to 772, and the next year it goes up to 776, that's slow growth.
But at the same time,
it is growth.
Spending a lot more. Like Blue Apron does that too.
Mm-hmm.
Like I feel like the revenues went up a little bit, but their freaking debt went extremely high.
But when companies are doing that, does that necessarily mean it's the best place to park your money? Probably not.
What if it's in like this huge like processing plant that's like...
Unless you're just waiting for that pop, just building it. It lit the fuse and it's just wait for it, kapow!
That would be insane. Everybody's buying Blue Apron now. It's going to come across the news.
Yeah, that bitch is going to get short squeezed. I'm telling you, she's going to pop up. She's going to pop up.
Blue Apron, $20 a share.
So those are some of my personal fundamentals, and that's most of the topics that I wanted to cover. Do you have any other ones that you really like to look at, or would say are like some of the more dire, quick ones to go through?
Well, a fun one to do, institutional ownership.
Oh, that is a good one.
Yeah, right now I'm on FinViz, just looking at the screeners, and they literally have a fundamentals tab that you click on, and there's it's like a candy shop here, man. Return on investment. Well, we didn't talk about that. Or return on equity.
ROI. Or remember, I think we're gonna do another one at Fundamentals Part 2 this week, right?
Yeah, we can do that.
Yeah.
Okay,
so we can talk.
Institutional
we'll do ROI, ROE.
One of my favorite institutional owners is Berkshire Hathaway. I listen closely to Warren Buffett. He got me to buy Store Capital. and I was looking.
Still in
he
it?
paid. Yeah, I'm still in. I'm still making money off it. I forget how much he paid for it, but he was making like 30 billion or 30 million in dividends a year, and it'd take him 11 years to get that paid back. That's like less than a 15-year investment, man.
Yeah, that's good. Doubling
Plus
your money in
growth.
11 years.
If it grows.
Oh yeah, that's not even including price appreciation.
Yeah.
That's really what you're going for with the stocks. Like, yeah, you want dividends.
He bought 18
you want
million
dividends
shares.
and growth. That's ridiculous.
Yeah.
Can you imagine doing that? He probably did that over the course of like 4 months.
He just dumped it in just like a bucket, just like piled a couple bucks in.
Dude, how do you think that little storage company thought when
it's not a storage
Warren
company?
Buffett, I thought it was a storage company.
No, it's a capital company.
Oh, what do they do? They do like they let out management?
Let me check. I'm pretty sure it's just like capital investments. But yeah, they might do that as well. But I think it's like holdings and stuff.
Huh. I might be thinking of something completely different.
Investment trust.
For what?
Single tenant operable real estate.
Oh, so it's like apartments.
I guess.
Townhouses.
Let me see. What we do. Here we go.
You don't even know who they are.
But it's about institutional ownership. When I look at institutional ownership, they don't show me what the company does. If theoretically that's the only metric I was doing it. Yeah, if that's the only metric that I clicked on FinViz was institutional ownership, it would pull up with these stocks for that reason.
Mm-hmm.
Maybe that's a bad idea. That is a bad idea. But I did that with Store Capital. I looked it up too. I looked at the dividends. Yeah, I just said how much a 15-year investment plus growth. I thought it was a good stock. I went in.
So
Warren Buffett.
What's an institution though?
It would be any kind of like funds too, like Vanguard funds,
mutual funds, hedge funds,
indexes, and stuff like that.
Basically, corporations that buy stocks.
Yeah.
The people that are actually controlling the market.
Mm-hmm.
Institutional ownership, yeah. The more the institutions, I also like to look at insider ownership. If the board of directors and the CEO and CFO are like buying the stock hand over fist, it kind of tells you something that they know something. It's a great way to look at it. And if the CEO alone owns 12% of the company, I kind of like that because his heart and his passion is going to be into pushing that stock price up.
12%. Could you imagine owning 12% of a company?
Dude, there's people out there that do it.
People out there that do it.
I think the Ford family still owns tons of the company. Like they own like controlling interest. I think it's like Travis Ford is like the CEO or something like that. Right? Like I don't know. I don't know his exact title, but so those are. I think that's a good stepping point off for the fundamentals there. That's a good because we're going to do another one because there's so much to go over. There's so much to go over. And we're kind of just going over some of our favorite metrics to look at in order to get a picture of the broader thing. Remember, there's no one thing.
Let's end on this. Let me end on this. When I look at these numbers, I look at them as a company themselves, how the numbers are doing. But that number's really relative to other companies.
Mm-hmm.
You know, it's kind of like a scorecard for me. Like, well, how's it scoring up against this company?
Mm-hmm. Especially within its own industry.
Yeah, how's it scoring up against the market? How's it scoring up the Dow Jones?
How does it go against the Treasury bill? If I can put my money and make more money in the U.S. Treasury than the stock, then why are you going to look at it?
Are you buying T-bonds or T-bills?
No, never.
Why?
Until I'm a multi-millionaire, I have no reason to be in Treasuries.
Why not? It's the safest security out there.
I think gold would be. Gold
is the safest, like physical gold.
Mm-hmm.
We're not tied to it, though. Fiat currency, baby.
Yeah. I think everybody should own a pack of cigarettes and a bottle of whiskey because that might be used as currency during the apocalypse. Think about it. The apocalypse happened, and there's no more whiskey in 2 years.
Are you short the market? Because you're just going to be the richest guy in the world if we just short the market if the apocalypse happens.
Not if there's no financial system left.
Short everything. At least the markets go up, and you just get your fucking fake money. Cash it out right away.
Get your fiat.
Yeah.
Nathan, who are you watching this week?
Oh, shit. Who am I watching?
Do I need to start while you do that? I am watching HST. That's Host Hotels and Resorts.
Yeah.
They're one of my favorites. I've owned them. I've been in and out of them several giggity.
Giggity. Hell. Here we go,
several times over the past few years. They are a hotel REIT, real estate investment trust, that operates and manages luxury and upper upscale hotels. That's what it says, upper upscale. Not lower upscale, upper upscale. Not mid upscale,
nice.
upper upscale. But they own a line of Ritz-Carltons, Waldorf Astorias. They lease, I think it's over 400 hotels. They have a $14 billion market cap. They pay a dividend of about 4% right now, paid quarterly, and it's a $19.30 stock. Just like everything else, she's pulled down from her highs in January. She still has room to run. She's up 7% for the past month, but still down 6% for the past 3 months. So she's at 1930 now, and she went all the way up to 2110. So I like her as kind of a slow grower. But I really like that dividend. And she also has very good volume. I know that's something that we talked about in a previous episode, but she has good volume. So when the stock has good volume, that has impression by Wall Street and the institutions out there. So I feel like there's some good potential here. And I really like the space. I like the upscale hotel space. As far as owning business. So it's something I'm watching. I'm not owning yet, but I'm watching. If she can pull back below 19, I'll get a little more excited. So I'm watching her. She's at 1930. I'm going to see what she does until the end of the week.
Host Hotels.
Host Hotels, HST.
That's exciting. I guess kind of play with that little theme of the podcast. I'll do SPLV. That's the low dividend or low volatility. Volatility. Low volatility portfolio of the S&P 500. It tracks volatility weighted index of the 100 least volatile stocks of the S&P 500. I think why do you like it? I mean, it kind of goes with why we do fundamentals in the first place, man. One of the lower volatilities is kind of like consistent and standard gains. Like you want to see consistency and growth, right?
Exactly. And a lot of these lower volatile stocks are companies that already have that consistent cash flow, that consistent revenue stream and sales, like your Dow 30 companies. I imagine that those companies make up a good chunk of that portfolio. Things like that, like your Coca-Cola, some of your packaged goods. Stuff that doesn't really no high movers. But why do you like that? Why do you like that for the short term?
Volatility weighted. Short term?
Yeah. Are you looking? Why do you like that for short term?
Oh, I don't like that for short term. If I was doing short term, I'm doing SPXU with a short.
Ooh.
Yeah.
Okay, so why do you like it? Why do you like it for the long term? Just is it like a dividend play, or is it like
no? I mean, I feel like it's
park cash.
I think it's a good place to park cash.
Okay.
I think it's a spider fund, so no, it's a power shift fund.
The SPs are always great. Anything SP is.
Yeah, 2.3 dividend yield. That's nice.
That's solid for low volatility stock.
$46 stock. That's pretty nice.
Are you able to get the top holding real quick, or the top 3 on that?
Maybe,
I'm just curious because I'm curious if it's like packaged goods in there, or if they got like gold miners. I really don't know.
That would be awesome if it was gold miner. Straight gold miners, they do so well.
That's what GLD is, isn't it? Or AGX or something?
Nug or something like that.
GDX? I don't know. I don't remember. JNUG. There's so many of them out there. Triple leveraged, bull, China gold fund.
ExxonMobil, Berkshire, Pepsi's in there.
Wow. So yeah, I like those companies.
Yeah.
That's a nice. That's a nice like little top 3 right there. All right. Well, anything else you want to kind of mention before we begin to wrap it up here?
No, I can't wait for part 2.
Part 2 is going to be fun. Real quick, just remember that there's no one metric you can look at. Don't take it all as a bigger picture. Take everything into account, and let's see if all those numbers kind of match to your flavor. We're going to put a review of. I'm going to just highlight the topics that we talked about. I'll put those in the show notes so that you can see the things that we highlighted. I know it was dense. It was a lot of stuff to kind of take all
Email
at once.
us. Leave a comment.
Yeah, where can they email us for questions, comments, suggestions, concerns, or insults?
That's rebeltradinggroup@gmail.com. That's rebeltradinggroup2gs@gmail.com.
And we are on Facebook. We need to get more active with it.
Oh, yeah, we do. We need to get a social media person.
But
hire some interns.
Yeah. Hey, at one point. At one point, hopefully. That's my goal. Have interns. But we do have
unpaid,
a Facebook
but you
page.
get the experience.
Yeah, you get the experience of hanging with us. I had fun today, Nathan. We'll do it again maybe Thursday?
Yeah, we do Thursday.
I like it, man.
Yay!
All right, fundamentals. See you guys on Thursday.